Have you ever noticed how everyone talks about becoming a millionaire, but hardly anyone talks about what comes before that? Like we're all supposed to just magically jump from having a few $1,000s in our retirement account to suddenly being millionaires, as if there's nothing in between. But here's the thing that nobody wants to admit. Most people never even make it to $250,000 in investments, not $1 million, not even a quarter of that amount. They spend their entire working lives contributing to retirement accounts, following the advice they hear, doing what they think they're supposed to do, and somehow they never break through that $250,000 barrier. This isn't just some random number I pulled out of thin air. $250,000 is actually a critical milestone in wealth building that separates people who are on track for a comfortable retirement from people who are going to struggle financially in their later years. It's also the point where compound interest really starts to kick into high gear and your money begins working harder than you do. But the brutal reality is that the majority of Americans reach retirement age without ever hitting this number. They get to 65 with maybe $50,000 or $100,000 saved. Look at that balance and realize with horror that they're nowhere close to having enough to actually retire. So why does this happen? Why do most people never cross $250,000 invested even though they had decades to do it? That's exactly what we're going to break down today. And I'm warning you right now, some of this is going to be uncomfortable to hear because the reasons people don't hit this milestone aren't usually about bad luck or circumstances beyond their control. They're about specific behaviors and mindsets that keep people trapped below this threshold for their entire lives. And if you recognize yourself in any of these patterns, the good news is that awareness is the first step toward fixing it. Let's start with the most obvious reason people never cross $250,000, and it's simply that they never start investing in the first place, or they start way too late. This sounds ridiculous because everyone knows they should be investing for retirement. It's not exactly secret information, but knowing you should do something and actually doing it are two completely different things. The number of people who reach their 30s and 40s without a single dollar invested is absolutely staggering. And it's not because they couldn't afford to invest, it's because they kept putting it off, telling themselves they'd start next year or after they paid off their car or when they got that raise they've been expecting. Here's what this delay actually costs you, and the math is going to make you sick if you're someone who waited. Let's say you start investing $500 a month at age 25 and you earn an average 8% annual return. By age 45, you'd have about $297,000. You cross the $250,000 threshold and you're well on your way to a comfortable retirement. Now let's say you waited until age 35 to start investing that same $500 per month. By age 45, you'd have only about $92,000. You're not even close to $250,000, and you'd need to keep investing for another full decade just to get there. That 10-year delay cost you over $200,000 in wealth. $200,000 just evaporated because you spent your 20s telling yourself you had plenty of time to worry about investing later.
The excuses for not starting are always the same. Student loans, low income, need to save for a house, planning a wedding, want to enjoy life while young, car payment. Every single one of these sounds perfectly reasonable in the moment, and that's exactly why they're so dangerous. You can always find a reason why now isn't the right time to start investing. There will always be something else you could do with that money. But here's what nobody tells you. If you don't make investing a non-negotiable priority from the very beginning, you will never start. There will always be another excuse, another expense, another reason to delay just a little bit longer. The people who actually cross $250,000 and go on to build real wealth are the ones who started investing immediately, even when they couldn't really afford it. They invested $50 a month when that's all they could scrape together. They lived with roommates longer to free up money for retirement contributions. They drove older cars and skipped expensive vacations in their 20s because they understood that money invested young is worth exponentially more than money invested later. They didn't wait until investing felt comfortable or convenient. They started immediately and figured out how to make it work. But let's say you did actually start investing. That still doesn't guarantee you'll hit $250,000, which brings us to the second major reason people never cross this threshold. They don't invest enough. They contribute just enough to get the company match on their 401k, which is usually 3 to 6% of their salary, and they think they're doing great because at least they're getting that free money from their employer. And yes, getting the match is better than nothing, but it's nowhere near enough to actually build substantial wealth. Let's run some numbers to show you what I mean. If you're making $50,000 a year and you contribute 6% to get your full company match, that's $3,000 annually, or $250 a month. At an 8% return over 30 years, that grows to about $373,000. Okay, you crossed $250,000, but just barely, and you're still not going to have enough to retire comfortably. Now let's say you increase that to 15% of your income, which is what financial experts actually recommend. That's $625 a month, and over 30 years at 8% returns, you end up with about $932,000. You're approaching millionaire status just by more than doubling your contribution rate. The difference between contributing 6% and 15% of your income is the difference between scraping by in retirement and actually being comfortable. But most people never make this jump because they look at their paycheck and think they can't afford to contribute more. They've already structured their life around spending 94% of their income, and cutting that back to 85% feels impossible. So they stay stuck at the minimum contribution level for decades, slowly building a retirement account that will never be enough.
This is where lifestyle inflation absolutely destroys people's ability to build wealth. Every time they get a raise, instead of increasing their retirement contributions, they increase their spending. They move to a nicer apartment, they upgrade their car, they start eating out more often. Their lifestyle expands to consume every penny of the raise, and their investment rate stays exactly the same. Someone making $50,000 contributing 6% and someone making $100,000 contributing 6% are both only putting away 6% of their income. The person making more has a nicer lifestyle, but they're not building wealth any faster. They're on the exact same trajectory to mediocre retirement savings. The third reason people never cross $250,000 is that they cash out their retirement accounts when they change jobs. This is one of the most financially destructive things you can possibly do, and millions of people do it without even understanding the damage. They leave a job, they've got $15,000 or $30,000 in their 401k, and they think that's free money to pay off some debt or take a vacation or put toward a down payment on a car. So they cash it out, pay the taxes and penalties, and blow through what's left in a matter of months. Here's what they don't realize. That $20,000 they cashed out at age 30 would have grown to about $200,000 by age 65 if they just left it alone. They traded $200,000 in future wealth for $15,000 in immediate cash after taxes and penalties. That's possibly the worst financial trade in history, and people do this over and over throughout their careers. They cash out when they're 25, when they're 32, when they're 38. Each time they're giving up hundreds of thousands in future wealth for a small amount of instant gratification. The people who actually build wealth treat their retirement accounts like they don't exist. When they change jobs, they immediately roll that 401k into an IRA or into their new employer's 401k. They never even consider cashing it out because they understand that money has a job to do, and that job is to grow for decades until they actually need it in retirement. Touching it early isn't even on the table as an option. But for most people, retirement accounts are treated like emergency funds or windfall cash that they can tap whenever they feel like they need money. This pattern alone keeps millions of people from ever reaching $250,000 because they keep resetting their account balance back to zero every few years. The fourth reason is fees, and this one makes me genuinely angry because it's so avoidable yet so common. Most people have absolutely no idea how much they're paying in investment fees, and those fees are quietly eating away at their returns like rust slowly destroying a car. They see an expense ratio of 1% on their mutual fund and think that sounds like basically nothing. 1%, that's so small. Except it's not small at all when you understand how it compounds over time. Let me show you exactly how much that 1% fee costs you. If you invest $500 a month for 30 years and earn 8% returns with no fees, you end up with about $745,000. Now run that exact same scenario with a 1% annual fee, so your net return is 7%. Your ending balance drops to $612,000. That 1% fee just cost you $133,000. And here's the part that should make you furious. You did all the work. You earned the money. You had the discipline to invest it consistently for 30 years. You took all the risk of being in the market. And some fund company took $133,000 of your money for basically doing nothing. Most people are actually paying way more than 1% when you add up all the fees. There are expense ratios on the funds, management fees if they're working with an advisor, transaction costs, 12b1 fees that a lot of people don't even know exist, Add it all up, and many people are paying 2% or more in total annual fees. At 2% in fees, that same $500 monthly investment over 30 years at 6% net returns only grows to $502,000. You lost almost $250,000 to fees. $250,000 just gone, handed over to financial companies who provided very little value in return. The solution is simple but requires you to actually pay attention to what you're invested in. Low-cost index funds from companies like Vanguard, Fidelity, or Schwab have expense ratios of 0.03% to 0.15%. That's not 1% or 2%. That's a tiny fraction of a percent. The difference between paying 2% and paying 0.05% in fees is the difference between retiring with $500,000 and retiring with $740,000. Same contributions, same time period, but one person paid attention to fees and the other didn't, and that inattention cost $250,000. The fifth reason people never cross $250,000 is panic selling during market downturns. This is where emotions completely destroy returns. The market drops 20% or 30% because of a recession, pandemic, financial crisis, or whatever the crisis of the day happens to be. Everyone is panicking, the news is screaming about how bad things are, and our investor looks at their account and sees they're down $30,000 from where they were 6 months ago. That paper loss feels like real money disappearing, and they can't take the stress anymore. So they sell everything and move to cash, telling themselves they'll get back in when things settle down and the market looks safe again. Here's the problem with this strategy. It locks in your losses and guarantees that you'll miss the recovery. The market always recovers eventually, always. Every single crash in market history has been followed by a recovery that reached new highs. If you stay invested through the crash, your account recovers when the market recovers. But if you sell at the bottom, you've turned a temporary paper loss into a permanent, real loss. And then you sit on the sidelines in cash, waiting for the perfect moment to get back in. And you never do, because the market has already recovered before you feel comfortable again. Let me give you a concrete example. Someone who invested steadily through the 2008 financial crisis, when it felt like the world was ending and the market dropped over 50%, saw incredible returns over the next decade. Someone who panicked and sold at the bottom in early 2009, then waited to get back in until 2011 when things felt safe again, missed out on some of the best returns in market history. That difference in returns over just those few years of being out of the market could easily be $100,000 or more on a typical portfolio. The people who cross $250,000 and go on to build real wealth are the ones who can control their emotions and ignore the panic. When the market crashes, they keep investing, or they even increase their investments because everything is on sale. They understand that market downturns are temporary and that the best returns come from buying when everyone else is selling. This isn't easy. It feels absolutely terrible to keep putting money into investments that are going down. But this ability to act rationally when everyone else is panicking is literally worth hundreds of thousands of dollars over a lifetime of investing. The sixth reason is lack of a plan and clear goals. Most people invest in this vague, general way without any specific target they're trying to hit. They contribute to their 401k because they know they should. They might have an IRA they put money into occasionally, but if you ask them exactly how much they need to accumulate to retire comfortably, or whether they're on track to hit that number, or what specific return they need to achieve their goals, they'd have no idea. They're just throwing money at retirement accounts and hoping it somehow works out. This lack of clarity means they have no idea whether contributing 6% is enough or if they need to be contributing 15%. They don't know if they're going to hit $250,000 by the time they need it, or if they're going to fall short by $100,000. They're operating blind, and when you're operating blind, you can't make informed decisions about your money. You might think you're on track when you're actually way behind, or you might be overly conservative because you're worried you don't have enough, when actually you're doing fine. The people who successfully build wealth have specific numbers and timelines. They know they need $1.5 million to retire at 65. They calculated that to hit that number, they need to have $250,000 by age 45. They know their current contribution rate and return assumptions will get them there, and they check regularly to make sure they're still on track. If they fall behind, they adjust by increasing contributions or cutting expenses. If they're ahead, they know they have some flexibility. This clarity allows them to make informed decisions instead of just guessing and hoping.
The seventh reason people never cross $250,000 is that they prioritize everything else over investing. This goes back to what we talked about earlier, but it's worth diving deeper into because it's probably the most common problem. People want to buy a house, so they save for a down payment instead of investing for retirement. They want to pay off student loans, so they throw all their extra money at debt instead of building wealth. They want to take nice vacations, drive decent cars, live in comfortable apartments, and have the lifestyle they think they deserve. And retirement investing becomes the thing that gets whatever's left over after all these other priorities, which is usually nothing. Here's the truth that nobody wants to hear. If you're not investing at least 15% of your gross income for retirement, you're prioritizing your current lifestyle over your future financial security. You're making a choice to have more now at the expense of having less later. And that's your right. Nobody can force you to save for retirement, but you need to be honest with yourself about what you're doing. You're not a victim of circumstances. You're making an active choice to spend on other things instead of investing, and that choice has consequences. The math on this is pretty simple. Someone making $60,000 a year who invests 15% for 30 years at 8% returns will have about $1.4 million at retirement. Someone making the exact same amount who only invests 5% because they prioritize other spending will have about $460,000. That's a difference of nearly $1 million in retirement wealth. Same income, same career, completely different outcomes based solely on the choice of whether to invest 15% or 5% of income. The people who build wealth figure out how to invest 15 to 20% from the very beginning, even when their income is low. They live with roommates longer, they drive older cars, they cook at home, they skip expensive hobbies and vacations in their 20s and 30s. They structure their entire life around being able to invest heavily, and then they enjoy the fruits of that discipline in their 40s, 50s, and retirement. Most people do the opposite. They spend heavily in their 20s and 30s enjoying life, then panic in their 40s and 50s when they realize they have nothing saved, and they spend their retirement years stressed about money instead of enjoying the freedom they could have had. The eighth reason is getting the investment mix wrong. This shows up in two different ways. Some people are way too conservative, keeping most of their money in bonds or cash equivalents because they're scared of stock market volatility. Other people are way too aggressive, putting everything into individual stocks or cryptocurrency or whatever the hot investment of the moment is. Both approaches lead to the same result, which is never building enough wealth to cross $250,000. Let's start with the too conservative crowd. These are the people who look at their 401k and see they're 100% invested in a stable value fund or money market fund earning 3 to 4% per year. They think they're being smart and safe, protecting their money from market crashes. But here's what they don't realize. At 4% returns, if you invest $500 per month for 30 years, you end up with about $348,000. That's better than nothing, but compared to the $745,000 you'd have at 8% returns from a stock-heavy portfolio, and you can see the problem. By being too conservative, you gave up nearly $400,000 in potential wealth. The argument for being conservative is that you avoid the stress and volatility of stock market crashes. And yes, your account won't drop 30% during a recession if you're in conservative investments, but you also won't build enough wealth to actually retire comfortably. You're trading short-term emotional comfort for long-term financial struggle. For most people under 50, that's a terrible trade. You need the higher returns of stocks to build substantial wealth, and you have enough time to ride out the inevitable market downturns that come along the way. On the flip side, you've got the overly aggressive investors who think they're going to beat the market by picking individual stocks or timing when to get in and out. They read about someone who made millions investing in Tesla or Bitcoin, and they think they can do the same thing. So they load up on whatever stocks are hot, chase performance, and constantly tinker with their portfolio. The research on this is crystal clear. The vast majority of people who try to pick stocks or time the market end up with worse returns than if they just invested in a simple index fund and left it alone. The data shows that the average investor underperforms the market by 2 to 3% annually because of bad behavior like chasing performance and market timing.
Over 30 years, underperforming by just 2% turns that $745,000 into about $557,000. You lost nearly $200,000 by thinking you were smarter than the market. And that assumes you only underperformed by 2%. Plenty of people underperform by way more than that, or lose most of their money betting on individual stocks that go nowhere. The people who successfully build wealth use boring, simple strategies. They invest in low-cost index funds that track the overall market. They choose an appropriate stock to bond allocation based on their age and risk tolerance, something like 80 to 90% stocks when young, gradually shifting toward more bonds as they approach retirement. They set it and forget it, letting compound interest do its work over decades. They're not trying to beat the market, they're trying to match the market's returns while minimizing fees and taxes. And that boring strategy consistently produces better results than trying to be clever. The ninth reason people never cross $250,000 is that they stop investing during tough times. They lose a job and stop contributing to their 401k. They have a financial emergency and pause the retirement investments for a few months that turns into a few years. They go through a divorce or a health crisis, and retirement savings falls completely off the radar. Life happens, and investing becomes a discretionary thing they do when circumstances are good, rather than a non-negotiable priority they maintain no matter what. Here's the problem. Those gaps in investing cost you way more than you realize. If you're investing $500 per month at 8% returns, every year you skip costs you about $30,000 in final account value because of the compound growth you missed. Stop investing for 5 years and you gave up $150,000 in potential wealth. That's the cost of those temporary pauses that never feel like a big deal in the moment. You tell yourself you'll catch up later, but you never do because you can't get back the compound growth you lost. The people who build wealth find a way to keep investing even during the tough times, even if they have to reduce the amount. They drop from $500 a month to $100 a month if they lose their job, but they don't stop completely. They understand that maintaining the habit and keeping the compound interest working is more important than the specific dollar amount. They treat retirement investing like they treat breathing. It's not optional. It doesn't stop because circumstances get difficult. It's just something that happens every single month, no matter what else is going on in life. The 10th and final reason people never cross $250,000 is simply that they give up or never really try in the first place. They look at their account balance when they're 40 and they've got $35,000 saved, and they do some rough math and realize they're way behind. And instead of getting serious about fixing it, they just mentally give up. They tell themselves retirement is impossible anyway. Social Security will have to be enough. They'll just work longer, or they'll figure something out when the time comes. They stop contributing altogether, or they keep making the same tiny contributions they've always made, knowing full well it's not enough but not caring enough to change it. This learned helplessness around retirement is incredibly common and incredibly destructive. People convince themselves that their situation is hopeless, that they've already missed their chance, that there's no point in even trying because they're too far behind. But here's the truth. Unless you're literally 5 years from retirement, it's not too late to make meaningful progress. Someone who's 45 with $50,000 saved can still hit $250,000 by age 60 if they get aggressive about it. They need to contribute about $800 per month at 8% returns, which is a lot, but it's not impossible if they make it a priority. The people who successfully build wealth never give up. They start late and they catch up by investing aggressively. They hit setbacks and they recover by increasing contributions. They make mistakes and they learn from them and do better going forward. They maintain belief that building wealth is possible for them, and that belief drives the behaviors that actually make it happen. Meanwhile, the people who give up guarantee that they'll never hit their goals because you can't accidentally stumble into $250,000 in investments. It only happens through intentional, sustained effort over many years. So there you have it. The 10 reasons why most people never cross $250,000 invested. They start too late or never start at all. They don't invest enough. They cash out retirement accounts when changing jobs. They pay way too much in fees. They panic sell during market downturns. They lack a clear plan and specific goals. They prioritize everything else over investing. They get the investment mix wrong by being too conservative or too aggressive. They stop investing during tough times, and they give up or never really try. Every single one of these is fixable. Every single one is within your control. The question is whether you're going to recognize which of these apply to you and actually do something about it, or whether you're going to keep doing what you've been doing and end up as another statistic of someone who reached retirement without anywhere near enough saved. The choice is yours, but the clock is ticking, and every day you delay is another day of compound growth you can never get back.